Live. Hi, everybody. Well, soon.
Welcome in. Come into our Zoom room.
Yes. Perfect. Just looking at everything here, making sure we're all technology set up. I think we're on Facebook. We're live on the webinar. I see people coming in. Everything looks good. Perfect. It's sunny. It's beautiful. I have AC in my office. I'm happy. They're good.
It is beautiful.
Yeah.
Puts you in a great mood.
Agreed.
Yeah. I think we went from winter to summer.
I know. There was like a one day of spring, I think. That was about it. Wonderful. Well, it is 12 o'clock. We'll wait just a couple of seconds as people are kind of joining us, but I do want to make an announcement. This is being recorded. So we record our webinars to make sure that anyone who's not able to attend live, that they are able to watch the replay. And we send out that replay a couple of days after the webinar. So just wanted to make sure everyone knew that we're being recorded and that was the intention, that we can share it to anyone not able to join us today live. Okay. And I think we'll get started. So today we're going to talk about the market, a market update, and behavior finance, which are two really big topics right now. And I have with me two of my lovely colleagues. I have Julia Carlson, who is our founder and our CEO. She is going to be talking to us about the behavior side of just what's going on with the market. Julia is, she founded our company at the turn of the century. She's an entrepreneur. She is an author. She is an expert on the investment landscape. She's a thought leader in the industry. And she is just a wealth of knowledge to be able to learn from today and also throughout my journey as a wealth advisor too. So glad to have you here, Julia.
Thank you.
And then we also have DJ Wright. So DJ Wright is our investment manager and wealth advisor. And DJ loves to discover and monitor investment opportunities. And he's really instrumental in crafting the various portfolios that we have used for our clients. And he's really good at knowing and understanding exactly what's happening in the market and being able to very easily tell us what's going on so that we all understand. And that's what he's going to do with us today. He's going to talk about what's happened last quarter, what we're expecting, and just kind of get into those gritty details that we all want to know. So excited to have you, DJ, with us as well.
Thank you, Sammie.
Good. I'll tell you a little bit about us at Financial Freedom. If you don't know about us, we were founded in 2001, and we are a comprehensive wealth management and planning firm. We're committed to helping our clients improve their long-term success and pursue financial freedom. And who we serve, we have three main categories. So if you are in one of these categories, reach out to us, but it's pre and post retirees who are wanting to build and protect their wealth, really important. People developing and growing their wealth, which is all, starting from your Roth and growing up, all those different pieces we can help you with. And then business owners, if you own a business and you're needing financial services in any capacity, we can help you, we can guide you, we can at least talk you through that. So those are our three categories of who we serve. And most important, our commitment is to care deeply about you and your financial life. And then who is this wonderful team I keep referring to? These are all of our team members. We have 6 advisors, 13 support staff. We're missing one person on this team photo, and that's just because he started last week. So we are continuing to grow and support our clients and all their needs. But yeah, beautiful team right here. And then really important, I want to make sure that everyone knows how to ask questions. So we'll stay on this page for just a little bit as you kind of get this phone number. So this number, you're able to text any of your questions throughout the webinar. And we will answer all of those questions at the end of the webinar. So if there's something that DJ talks about through the market update, please write in your question. We want to know what you're thinking, what we can help you with, and then text that to us. We will answer it all at the end of the webinar. So that's a magical number to text. We'll have it throughout the webinar as well, but write it down now if there is something that you need. And with that, I'm going to go ahead and turn it over to DJ to talk to us about the important stuff, the market.
Thank you, Sammie. Appreciate it.
Yeah.
So yeah, let's talk about the markets. There's always stuff to talk about. Every single day we could talk about something. And so, here we are. It's almost the middle of May, and we've been in this bear market now for going on a year and a half. That's a long time. And so we know it's tough to go through these. It's really hard. It's unfortunately, it's part of investing. It's the hard part of investing. We have to do it to succeed in the markets. But again, it's really tough. And I know that once you're in this for over a year, you start to kind of wonder, okay, is this actually going to ever recover? Are we ever going to get into the next growth phase? And so we believe, yes, we will. And I think it's really important when you're in this, so when you're deep in this kind of doomsday, everything's scary, to take a step back and really zoom out and think about the bigger picture. Think longer term. And it can be really helpful to look at history and look at past situations where we've been in something like this and kind of look at what happened. And I think that you'll find that there's actually a lot of good, a lot of positive things. And so that's some of the stuff we're going to talk about here today. So I think the big question on most people's minds is, are we going to enter a recession? I would expect that we will. So go ahead and just kind of mentally prepare for that. So yeah, we're probably going to get a recession called at some point this year. It's not a foregone conclusion, but it's very likely that we will. And, it doesn't necessarily mean that stocks are going to fall off a cliff, if we do go through a recession. We'll actually touch on that here in a minute. But if you look at this graphic here, this is the leading economic index, the LEI. And it basically kind of foreshadows economic activity and things like that. And so when you see it fall, kind of like what we've seen here this last year, generally speaking, we do see a recession come right after that. So it's been a pretty good indicator of a recession. So that's one reason that we are expecting it. And the other thing is, the Fed's kind of they've been slowing the economy down intentionally. So it was always a real possibility that we were going to see a downturn. Now, it doesn't necessarily mean we're going to see this deep, painful recession. Not all recessions are created equal. We definitely do not expect anything like 2008. We're expecting this to be fairly mild. It could be a pretty quick recession, they call it, and then great, now we can go on to the next phase. So it's something that we'll see what happens here. But what does it mean for stocks if we do go into a recession? Well, I can tell you that it doesn't necessarily mean we're going to fall off a cliff again and see a 30% drop. The stock market is very forward looking. So it's always looking into the future about a year. And like we mentioned, we've been in this downturn for well over a year now. So a lot of the pain that we may have seen over this last 16 months could have been kind of the foreshadowing of the recession that we may enter this year. So if you actually look at past recessions and how stock markets, have reacted, it's kind of a mixed bag. So one thing I want to point out here is if you look at 1990, so you can see it's the second recession here on the left, and it was a pretty quick recession. And what happened is the year before the recession, we were actually down about 15% in the stock market. And then the year that we had a recession called, the market was up 8% for that year. And then the very next year after the recession, it was up another 14%. So that could be something that we may see, with this one, where we expect a pretty quick short recession. We were down 20% last year. This year, we'll see we're already up 7% for the S&P 500. So, we actually have that going for us. But just keep that in mind, that if we do see a recession called, it doesn't mean, okay, we're going to just crash. A lot of what we've experienced already could have been most of what we're going to feel. Doesn't mean we're going to retest the lows of last year. So in the goal, right, of stepping back and kind of looking more at the big picture, I think this is a great slide for that. So this shows you what your returns, or your percent return for various indexes if you got in right at the peak of the dot-com bubble. So right before we experienced a pretty big downturn. And you can see that we go through the dot-com downturn, and the NASDAQ was down 75%. So really a big downturn for that. They're more of a tech index. And then you have the Great Recession of 2008. Of course, we all know about that one. Very tough. It was one of the worst we've seen. And then from there, we went on a nice little run. And of course, there was ups and downs along the way, but no official recession was called until we got to 2020 from COVID. And it was a very quick recession, but a steep decline in the stock market. And then we recovered from that. And then we fell from where we are right now with everything that's been going on. And that's kind of where things land. And so if you look at the Dow, now this is the real Dow return. So what that means is it's been adjusted for inflation. So the actual return would be significantly higher than this. But this is your actually, growth of wealth accounting for inflation. So again, getting in it right before a crash and then ending in the middle of a bear market, pretty bad timing, but the return is still 60% for the Dow and about 51.5% for the S&P, and the NASDAQ up 36%. And note that the NASDAQ, it got hit really hard from the dot-com bubble, and it also got hit hardest from this current bear market that we're in as well. So even through all that stuff, you're still growing your wealth. You're still doing really well. And so that's the importance of stepping back and realizing that over time, the markets do really, really well. You just got to stick with it. That's the most important thing. So a potential positive that we have going for us now as well is the Fed is likely going to pause their rate hiking cycle. So the Fed's been raising rates very rapidly for the last year. And their goal was to slow the economy down to get inflation down. That was the most important thing to them. And we've seen that. It looks like it's actually working. So we're starting to see growth slow down a bit. Inflation is cooling. Actually, just today, we had our inflation number come out, and we're at 4.9% year over year. So we're below 5% again. Now, this is still much higher than the 2% that they want, and they're going to keep, hoping that we get down to that. But this is a whole lot better than the 9% we saw last summer. So we've already made huge strides in reducing inflation. And so what that means is we may have seen our final rate hike just last week. So they raised rates by a quarter of a point. And we'll wait to see what they do come June. The markets are expecting that they pause and that they no longer raise rates. And in fact, the markets are actually expecting that sometime later this year, we could actually see rates be cut, if we do see a recession, and they could actually cut some rates. So what does that mean for the stock market after the Fed pauses? It's pretty good. So when we look at history, they haven't done this too many times. I believe it's 6 or 7 times that they've actually raised rates like this. And when we look at the day that they pause, and we're looking at the S&P 500, and we look at the returns, again, they've been very good. So let's just go through this briefly. If you look at the average return So down there at the bottom, 3 months after they pause, the average gain is about 7%. Very good. When you look 6 months after the pause, the average gain is 13%. And then when you look a full year out, average gain of just about 19%, 1 year after they pause raising rates. And let's keep going. So 18 months, now you're up 21%. 2 years later, look at that, 35% is the average gain, and the median return is 45% 2 years later. And then when you're 2.5 years out, the average gain is 43% with a median return of 62. So that's very promising. That tells us there's a lot of opportunity from where we are right now. Of course, there's a few in here that, we were still down. I think these are some outliers. You had the .com deal where we were still down. And then, of course, when they paused in June of 2006, when you look 2.5 years later, we were now in 2008. So that's kind of another outlier there. But generally speaking, the markets, they like it when the Fed pauses, and that they've done pretty well. Let's talk about bonds. How do the bonds do after the Fed pauses? We're coming off a really tough year last year for stocks and bonds. And in fact, it was the worst year we've ever had for bonds, which was unique. Usually when stocks are down, bonds actually do pretty well. We didn't see that last year. And it was because the Fed was raising rates the way that they did. Bond prices and interest rates have an inverse relationship. So as rates come up, bond prices go down. And that's what we saw last year. So with the Fed pausing and potentially even cutting rates sometime in the future, that can be a good thing for your bonds. Let's look at the intermediate core plus bonds. So that's the blue bar. These are kind of longer term, intermediate term bonds. These got hit really hard last year, but when the Fed pauses, 6 months out, the average gain is 7.73% for these. When you look 1 year out, the average gain is 12.33%. These are bonds we're talking about. When you look at the 3-year annualized, 8.5% per year over 3 years. And then of course, 5 years at 9% annualized return. I mean, that's almost like stock market returns. That's pretty incredible. So again, it was a tough year last year, but bonds actually look pretty good right now. So if somebody who's more conservative, or you're in retirement and you have bonds, keep those, right? It's not a time to abandon bonds and go to something like cash. They could do very well coming up. The resilience of the stock market is pretty incredible. So you can see here, this goes back to 1936. Again, this is the S&P 500. And if you put $1 in back then, it'd be worth more than $5,700 today. So pretty good growth. But what's amazing is look at all the challenges, all the things we've gone through. And again, these are just some of them. Of course, there's plenty more. Just kind of scroll your eyes through that. And, it's amazing that, whenever we're in these, people say, okay, this time is different, right? This is different than all the past. This one is different. People thought that for all of these, that, hey, no, this one's different. We may not recover from this, but the stock market didn't care. It kept going up. And so, I'm not discounting that we go through these challenges and these, events that can be very scary, and they are scary. Absolutely. Totally understand that. But when you look at the resiliency of the stock market, you're investing in lots of companies and they continue to, progress. If we continue to build our quality of life and move forward as a nation and as a world, the stock market's going to keep going up. And so, yes, challenges are going to continue to face them, but we really believe that we'll get through all of them, and the stock market will as well. And with all this volatility, it's actually a great opportunity. So I think you can look at a lot of challenges like that they're actually opportunities for you. And if you just look on this right side here, and don't worry about the dates, but you can see the blue bars are the downturn. So the amount that the stock market declined. And then once that decline stopped and we started going back the other way, the orange bar is 12 months later, what the gain was. And it's amazing how much the stock market can just roar back when things are from where things are looking so bleak, right? So rough, and they still come back. So the average gain has been 49% over 12 months. Now, of course, you have some years where it was really big, and that certainly is pulling it up a bit, but still, you know, great returns coming off these lows. And so that's really important to remember, that when things are feeling really bad, really rough, the market is down, just know that that next growth phase, that next market recovery is around the corner, and you just got to keep sticking with it, and it's going to come. And the last thing I'll talk about here is, you know, waiting for a recession to end can be really, really damaging. So whether you have cash on the sidelines that you're waiting to invest until things look better, or if you're invested now and you're considering moving things to cash and waiting until things look better, you know, it can really hurt you in the long run. We wouldn't recommend that. You know, when you look at this, so these are all these different colored lines are various recessions. And if you invested $100 on that first day of the recession, so the very first day of the recession, you put $100 in, you can see that the gains have been really great. So when you look at 3 years out, only one time were we still down, and that was the 2008 deal. And of course, when you look at 10 years out, no matter what, you're up for all of these, every recession that we ever had. And some of the gains, I mean, have been really great, like $100 turning into $500 over that period, 10 years. So, you know, that's one of the things I'll leave you with is it can be scary, and you can definitely want to stop the bleeding, want to avoid any further loss. But what we found is that generally ends up hurting you in the end. You've come this far, you know, you're a year and a half into it. You can keep going, you know, stick with it, and you'll be rewarded for that. So, and we're of course always here to help you through it, to chat through these difficult times. Julia.
Yes, that was awesome. Thank you, DJ.
Yeah, absolutely.
I feel like cautiously optimistic maybe sums up everything you shared.
That's perfect. That's perfect. Yeah, I think that's a great point, because again, we're not out of it yet. You know, there's still going to be some volatility, and expect that as we work through all these challenges, but just kind of step back and think bigger picture. And it's actually, it's positive.
Yeah, I think you just shared so many a recap of the good last 16 months that we've been through, and it's been tough, but I think we are closer to the end than the beginning for sure. I think the pause with the Fed is helping this market. I think we also the debt ceiling, that's a hot headline right now, and ultimately we do believe that they will negotiate and get that worked out as the date gets closer. But I think there's a lot of good things ahead of us, so we have to stay in that forward looking. We have to be forward looking, just like the market is forward looking.
Mm-hmm. Yeah.
And that all falls under our emotions and behavioral finance and behavioral economics. And so what really is this as we shift gears into understanding our emotions and our behaviors as it has to do with our money and making decisions? So behavioral economics is the difference between what human investors should do and what they actually do. This is where traditional finance and economics meet psychology, and emotions are a big piece of why we do what we do. So we are going to dive into this. Our emotions drive our behaviors, and we actually believe emotions are a very good thing. God gave us emotions, so we have to feel them and believe that they help us navigate this world that we find ourselves in. They provide insight into how we are feeling, And yes, self-awareness of our emotions is a really important part of this. And that should be developed as you grow as an individual. Emotions can help us communicate with others and share how we are feeling. Because here's the deal about emotions. Your emotions are never wrong. And I use this with my husband all the time. I'm feeling this way. These are my emotions, and my emotions aren't wrong. So someone can't tell me not to feel this way, because this is my experience. So we believe, yes, emotions are important to like examine and help us understand kind of underlying the biases maybe that are, or the experiences that we've been through. So we're going to talk more about that. But we also think that emotions can motivate us to pursue our dreams and our goals. And while some emotions can be unpleasant, I like the word unpleasant because it's not fear or shame or guilt or bad. It's just unpleasant when you have a negative emotion. But I think those unpleasant feelings can serve as an important function in helping us adapt and thrive in our environments. So it may be, I know there's probably some of us that look at all the facts that DJ just presented and still have worry. And what about the war? And what about the debt ceiling? And what about all of these things that are happening? The politics, that's a huge thing that are on a lot of people's hearts that run their emotions. And they've never seen America in this state. And, there's just, there's heightened emotions around a lot of headlines out there. And it's hard to say, hey, there's nothing to worry about. The future is bright. And I think logically we can look at some of the charts and say, okay, yeah, this makes sense. Like this is normal. We've been through this historically. But when our emotions come in and our feelings come in, and we get triggered by something, the reactions then can take over. So with all these bad headlines about the markets, the gas prices, the debt ceiling, the cost of groceries, inflation, social media, which then adds everyone's opinion to it, of course, it's hard to not feel anxious about the world around us. We, like DJ said, we never want to discount this or how we are feeling. But we also want to remind us, every one of us, our clients and ourselves, that the headlines out there are meant to engage us. They're meant to trigger us, and they do this by fear. So it's okay to feel the overwhelm, to feel scared, to feel worrisome. It's natural, like as DJ shared, to watch the stock market and the volatility and take these wild swings and want to have a reaction. I think it's what we've been through. For those of us that were investors in 2008, what we're going through now could actually be a trigger back to what happened in 2008, and we may fear that. And so that common impulse is, I don't want to go through that again. And the impulse is to sell. But from historical statistics, this has been proven to be disadvantageous to long-term investors. DJ shared that. When we are experiencing those high emotions, we tend to go to black or white thinking. It's like all in or all out. But as experts here, we know that there is a customized mix of investments that fits our clients' personal situations and their risk tolerance. So just like DJ shared about bonds are going to have a really good outlook moving forward. They had last year was hard because of all the interest rate increases, but now moving forward, there's great opportunity in bonds. And so I would caution the black and white thinking and understand there is a common ground. There is this customized mix of investment that works for you based on your situation. And so, that's the important piece to understand. And as advisors, we can help with that. Okay, as you've seen by our PowerPoint, we have shown you a lot of charts. So I think as analysts and researchers and our financial professionals, our team loves to look at charts. So I understand it could be helpful for some, but not so helpful for others. But hopefully some of these will explain them in a way that you can take something from them. But this chart shows the patterns and explains the behaviors and actions that investors take during market cycles. People usually tend to sell when the market is low because they are having a lot of negative feelings and emotions around the market. However, the opposite is what should be happening. Investors should be investing into the market when it's at its low point. And so, DJ, because you're the one I can talk to here, where do you think we're at right now in this market?
This is good. Well, we're not to hope yet. So we're in the panic, or what is that? Despondency?
Despondency. So I Googled despondency, and here it is. A state of low spirits caused by loss of hope or courage. I think that's exactly where we're at.
Yeah, that sums it out. Yeah.
We have so many conversations with our clients that there is a lack of hope in our country right now. I totally feel that. And there's a little bubble that should be between despondency and hope, and that's skepticism. Like that's our next spot. But as you can see, as that is probably the best time to lean into your investments, as it says there, the point of maximum financial opportunity. We are in this bottoming out to figure out, how do we start this rebirth? How do we start this new bull market that we're going to go on for years into the future? So, and then, opposite, you can see even in the end of 2021, so before last year, we were definitely in euphoria. Like everyone wanted to be an investor because we were seeing returns of 20, 30, the returns were so good and everyone wanted to be an investor, but that was actually the time that was the point of maximum financial risk because we were at the height. Now, of course, we never know this at the time, but I think the more experience you have and the more you can zoom out and understand market cycles, you get a feeling for, this is what's happening here, or this is what's happening down here. And so, our job as your advisors is to ensure that you are not selling low and abandoning your investment strategy when we are in times of panic and despondency, which is where we're at right now. This is where it matters to stick to your plan. We want to understand, yes, how you are feeling and your emotions, because we really care deeply about that. And we care deeply about your ability to sleep at night. Like we never want to discount how you're feeling, because that's true. Often, if we can understand though how you're feeling and ensure that you are in the right mix of those investments for your personal plan, and if not, make slight adjustments, not all one way or the other way, we will get you and guide you to your goals. So I'll say this, someone on our team said this, and I just loved it. It's okay to be scared because we're not scared. Like we've got you, and we will navigate this and get you to that other side. And riding this wave is the right thing to do. Here's another slide. I promise the charts are almost done here. But I think the idea of this is we have ridden these market waves before. So this is going back to 1971, the ups and downs of 6 market cycles we've been in from 1971 through 22. And so, this chart will continue to go, but it's going to continue to look like this. And the bigger the bubble, the bigger the bull market, the bigger the upside. And so yes, part of the investment experience is going through the down, but the benefit of that is all of the upside. So we will get through this cycle, I promise. All right. So can I say the word I promise? I can't probably say the word I promise in the investment world, but as close to promise as I can. Okay. So there are natural biases that we have. And a bias is a tendency towards a particular perspective, like thinking one way or another. And it affects our ability to make fair judgments over time. It can be conscious, like, oh, I have this bias, I'm aware of it, or it can be unconscious, which is under the surface, and is influenced by our beliefs, how we were raised, our experiences, and the world around us. How, social media is a big conscious or unconscious influencer. But as an investor, there are 5 common investor biases that we need to be aware of, and most likely will probably fall into one or the other. I wish we had because of compliance, we can't use the chat feature, but I would love to understand, if you're like really saying, oh, loss aversion is mine, or following the crowd is another one, like that would be good feedback. So maybe you could text it in or something if you have comments around this. So number 1 is loss aversion. So these are investors that try to avoid losses on investments to the point where they may avoid investing altogether because the pain of losing is stronger than the good feelings of a gain. So they don't even want to put themselves in the investing game a lot of times. Number 2 is overconfidence. So this is the investors that are basically overconfident in their own ability and expertise. And this actually causes them to maybe overtrade, make too many changes in their retirement accounts. Maybe they're doing things at the wrong time or risking too much in one particular stock, or the hot stock the neighbor gave them that could put you into overconfidence biases. Number 3 is, as we talked about those patterns earlier, sometimes investors follow kind of that herd mentality. It's following the crowd. Instead of thinking for themselves and thinking, okay, what's the best personalized mix for my situation? Going to be more aggressive because everyone else around them is. So it's kind of like that peer pressure. And this could lead to investors buying in because others are, even if the price is too high, or selling and going to cash because their coworker told them that was what they should do. So that would be following the crowd or herd mentality. Number 4, familiarity. I can't say that word very good. But this is where you buy what you are really comfortable with, and what you know, which could lead to not diversifying your overall portfolio. So where we see this is if a client works for a publicly traded company and they want to just own that stock. And then when they retire, they just want to own that stock because they feel comfortable, they know it. But again, there's a lot of risk in owning just one stock. And then 5 is gut feelings. So you don't really have the data or the research, and you just kind of make decisions shooting from the gut. And where we see this often, not mainly in investments, but we actually see this in people just not having a plan. Like, they may have some loose goals. I want to buy a house someday. Yeah, the kids are probably going to go to college. Yeah, it'd be nice to retire, but they don't have a financial plan around that where they're intentionally moving towards that goal. And they're kind of going from their gut, like a gut financial plan. So we would be curious, which one are you, 1 to 5? So if you have that text number, you could text us in and we could talk more about that at the end here. But, based on your biases, it may lead to successful investing strategies and behaviors, but other beliefs may actually lead you to behavioral biases that are counterproductive to a good long-term financial plan. So self-awareness is key here. And I think also working with a team of experts like us that understand these biases and can actually point them out to you as a partner is essential for success. So the big question is, how do we get out of this chaos? And we think the first step is awareness to what is happening. So, acknowledge what's going on, getting educated, understanding how you are feeling about it, and having the confidence in building a long-term financial plan. And I think the biggest thing is knowing that this too shall pass. It will pass. Look at COVID. Like, COVID is a distant memory, right? Things changed because of that, but this too shall pass. We are on the other side of it. And also know that the logic and all the charts and everything we've shared to you today and what DJ presented, can give us this temporary confidence. Like, oh, we feel good about this. I just learned about it all. And then potentially tomorrow, the market could fall 1,000 points, and then you get triggered and you go into these other negative feelings. So I think it's really important that the long-term effect of being a confident investor is, willing to feel those emotions and being with that, but then also having the courage to think differently and having that willingness to think differently to get out of the chaos. So, I share this in my book, and it really applies to all situations. When you're not feeling confident, where do you start? And I believe it starts with desire. Like, what do you want? What is your outcome? Is it financial freedom? Is it building your wealth? Maybe you're just getting started and you're accumulating. Maybe it's protecting your wealth. You're in retirement. I just need to protect my wealth. I'm not in accumulation mode. I'm taking money out and I need to preserve this. So it's confidence in having the portfolio that is built to withstand the type of volatility that we're in. So knowing what you want is one thing, but then the next step is to decide. So to decide is making a decision. And to decide is to cut off all other options, right? It's all the sides words that we have is to cut off. So when you are committed to a long-term financial plan, you won't abandon your strategy in times like this. And it's understanding when you're indecisive, like, should I do this or should I do that? When you don't have that strong commitment up front and that decision that you made to stick with your plan, it's like riding a roller coaster and deciding to get off when you're upside down, right? That's never a good choice. So really decide to commit to that long-term plan. Determination. So this is that we're in that determination part right now. In the moment of fear and worry is when our determination is really needed. It's courage to take the course. It's courage to stay the course is what I meant to say there. It's listening to wise counsel, to trust us, to allow us to worry about the investments, so you don't have to. That's a lot of why you work with us as professionals, is let us do the worrying for you. And determination is a firmness of purpose in your legacy, in your plan, in your investments, that this too shall pass. Like, we will get on the other side of that. And that lands you at discipline. And discipline is when you have decided, you've held fast to your decision, you've developed new capabilities, new thoughts, new habits, behaviors take over. And that is discipline. And that becomes a new state for you as you have that experience. And that leads us to the confidence. And I love this picture. This is a little just down the road, about probably a quarter mile. I can walk to the end of our road and see this view, over the Yaquina Bay in Newport. And it's just a beautiful picture. And it reminds me of freedom. And freedom is very similar to confidence. And when we look at that chart I just shared, it's actually discipline that brings freedom. And you wouldn't connect discipline and freedom, right? Those two words don't feel like they go together, but they actually do go together, because you've been disciplined to the plan. And so this is the way that we manage your investments. It's by our discipline, our science, our process. And that is what we hold fast to, not our emotions or reactions to what's happening. So as a recap, volatility can be rough for investors. But I was just, thinking about what DJ shared. Like since October of last year, we are up considerably, double digits, and to where we stand today. And we didn't think that that was going to happen in October. So things change quickly, especially in the markets. And so, avoid the common impulse to sell due to our emotions. Historically, this is disadvantageous for most long-term investors. And stock markets historically have bounced back. We talked about a lot of that. And a confident investor will act according to reason and statistics in light of what we're going through right now. And lastly, empowered investors are educated. So thank you all for being here today. That is amazing, because you want to learn and you want to understand what's happening. And really, I think acceptance of we're going through these current market trends. It's a normal part of the investing experience. We're closer to the other side than the beginning. So I think that cautiously optimistic is a good theme. We'd love for you to continue to tune into our webinars. If you are a new to us and just listening to this webinar for the first time, consider working with one of our advisors. So we offer a complimentary consultation to help understand what services do you need? What are you looking for? Is it a good fit to work together? And know that any experience makes us better. So if it could be a learning experience, or it could be a great experience that we're really grateful for. But I think going through life experiences and taking the learning from them and living life with gratitude is the way to keep growing and going into the future. Mm-hmm. So with that, I am going to give it back to Sammie. Sammie is one of our wealth advisors here. We didn't really get to share a lot about Sammie. She also helps with our marketing. So you'll see her on our social media. You'll see both Sammie and DJ on our social media. And her little baby girl just turned a year. So
yes.
So we're just so excited, Sammie, that you've been able to navigate parenthood, being a wealth advisor in a bear market, doing it all. Reminds me of when I first started, 20 years ago, and was juggling all those very same things. So.
Oh my goodness. Well, thank you. I know. I just kind of dove right into the material. I was so excited to hear from you and DJ today. But yes, I'm happy to be here with you too. And I'm going to wrap us all up. So we actually have a few really great questions that I saw come in. So again, if you have questions, keep putting those in the text box. And as Julia mentioned, we do also offer complimentary consultations. So that same number, it's it's used for a lot of different things. So you can also text the word freedom to the 458-777-4458 number. And then we can also set you up if one question isn't, good, you want to actually sit down and talk with someone, you can do that too. So text us with that. And then as I wrap us up, I have to go over a couple little slides about LPL Financial. So LPL Financial is our broker dealer. I'm just going to run through a couple of these bullets. They are the largest independent broker dealer. So that's very important for you to know. That's why we work with them. They have SIPC membership, which means that there is protection out there, working with LPL Financial up to $500,000 account protection. And then the last bullet that I want to run through is the fact that all of our wealth advisors have our securities and license and registrations held with LPL Financial. So that's our partnership with them. And then lastly, all of the wonderful disclosures, just, take it all in. This is the very last slide. And I'm actually going to go through these questions that we got. Julia, DJ, are you ready?
Yes.
There's some really good ones. Okay, first question is, what exactly does recession mean?
Ooh,
question.
That's good. So I'll take this one. Yeah, there's So there's a couple definitions. A lot of people consider it 2 quarters in a row where GDP declines. That's not technically what it is. It's more vague than that. It's a widespread downturn in economic activity. That's basically what it means. So there's this board that actually calls recessions, and they look at a whole bunch of different factors. And when they're seeing, okay, there's enough signs here for us to confidently say, we entered a recession on this date. So that's really what it comes down to. It's a widespread downturn in economic activity.
Wow.
Yeah, technically last year we had 2 down quarters of GDP. So, by that determination, people say, okay, maybe we hit a recession. And that's why I think the worst of the market's behind us, because we kind of went through that downturn last year. But we may have a full on, everyone is in alignment with recession, like DJ shared.
Mm-hmm. All right. As a retiree, do you have concerns about the raising of debt ceiling? And should we continue to stay on course or change anything in case there is a default by government? That's a good question.
So yeah, that is a good question. So here's what I think, and Julia, then you can definitely chime in as well. But we've done this a lot. They've done this dance. They like to do it. I have faith that they will figure it out, just like they always do. They know the consequences if they didn't get it raise the debt ceiling. So, there's still some time. They're likely going to get it done just in time. We've seen this so many times. But as far as should you change anything, I would say no. I don't think you don't want to make any major shifts for something that's still unlikely to happen. Julia, what do you think?
Yeah, I would think as long as you know that you're in the right mix of investments for your risk tolerance, I would say no. I mean, I remember when they actually changed the rating on the Treasury because of the default or because the debt ceiling. And so, but even that was a blip on the little chart, right? So yeah, it's short-term volatility that it'll create, but over the long run, we will get on the other side of this. Like it's even so, and I would also say that the investments, primarily you're in either strong, American companies or international companies that are strong, or, I mean, I'm thinking of what percentage of our assets are in treasuries or,
Right.
Based on
Small.
the government, very small. Government bonds would be a very small percentage of our overall portfolio. Yeah.
Good stuff. All right. The last question that we have so far, but if you have a question, please text it to us as we go through this. But the last question is, what impact will the recent ESG rule have on financial freedom wealth management portfolios, so our portfolios? And what is our philosophy on ESG investments?
So I'll start with the second part there. So we offer it for clients that do want that. Now, that doesn't mean that it's incorporated in all our models. We have our models that it doesn't address that at all. But again, we're here to serve many different types of clients. So for somebody who that is important to, we can accommodate that. And then the ESG rule, I guess, Julia, do you know about this new rule? I know there's a lot of talk about ESG stuff lately, but.
Yeah, and I feel like that it could be relates to, I think they were on the 401ks. I feel like it could be into that. I was just at a conference and they were talking about ESG So let's define ESG, number one. So environmental, like are companies managing businesses for good environmental standards, and then social. So, you know, it could be, I mean, social can mean a lot of different things to a lot of different businesses. And then governance, which is, you know, like a board and having diverse perspectives. And so having, like, all companies should be paying attention to all these different factors that affect running a good business. And so what's happened over the last 10 years is this huge increase in making sure that companies are raising the standards of this. And so it's actually become a whole sector of investing, whether it's sustainability, you know, whether it's environmental, you know, a lot of different factors based on values of the investor. You can determine, you can invest in a way that is aligned with your values. And so, but the interesting thing is it's become a big marketing ploy. And, you know, and so I feel like it's been diluted in a sense. And there's actually been, like, last year was a record low amount of flows to these ESG funds. And so, you know, it was interesting to hear their perspective, but I think right now they're just putting more guidance and boundaries and, you know, protect what that means to have those standards is my take on it.
Okay. We did get one more question that came in. It's a hot topic for sure that we've heard, so I know we'll have an answer to this. And it's two questions in one. Do any of your portfolios invest in gold, and what do you think of investing in gold?
Very good.
That is good. Yeah, so we don't have it built into our current investment models. You know, there's certainly times where gold has its moments. Absolutely. When you look longer term, which is really how we try to invest for our clients, it doesn't even come close to keeping up with good, well-diversified stocks. So it's something that, you know, we can always incorporate for a client if it's important to them. We can certainly do that. But, you know, if you're really in it for the longer term, you know, you're thinking maybe 5 years out, 10 years out, that's, you know, gold's not necessarily needed. Stocks will likely do better than gold.
Yeah, I would agree with that. And you know, gold is very volatile. Like, you can, I've seen a lot of people lose money in gold, you know, and people have had great experiences with gold, but we're not going back to the gold standard. And so it becomes, you know, I think not an important asset class in comparison, like DJ shared, to all the other investment opportunities that we have out there. So that's what I have to say about that.
Right. Yeah. And I'd add, it depends on what you're getting it for. You know, if you're getting some gold because you're worried about a complete collapse of the world, sure, you know, gold would probably be valuable in something like that. But of course, that's, you know, that's a whole nother topic and deal that we addressed. It's unlikely. So as far as just built into like a normal, you know, it's your retirement money, your portfolio, it may not be as critical.
Yeah, we do have clients that want it. And again, that can go in their personalized approach. But we would hardly recommend more than 5% into that of your investments.
Yeah. Okay, well, that was all the questions that we have coming through the text. So we'll go ahead and close it up here. Again, this is being recorded, so we will send out the replay in the next couple of days, and we really appreciate you joining us today for the webinar.
Thank you.
Thanks, everyone. Have a great day.